Proud. So this will be super fun tonight, because you're going to get all your questions answered, which is sort of amazing, right? So anything you have to ask, it'll be great. This is the lending night, and it's actually, kind of one of my favorite nights because this is your chance to talk to a lender where you don't have any, there's no nervousness to it, right? Some people will say like, I might not be going for traditional lending or whatever. Why would I want to know this? Well, you all need to have some sort of lending relationship at some point in a business because of things like a line of credit or what have you. So we're lucky to have Fred McConnell with us from Madison Development Corp today. Fred has a great background. I'll let him tell you a little bit more about himself, but he did work for Associated Bank, so he kind of knows that banking side, and then now he's on this CDFI side. So he can really kind of give you the spectrum of like, why should you go here versus here and what this all means. So Fred, thank you for being with us tonight and really glad to have you here. So I'll let you take it from here. Mute. Uh-oh, Katie, what do we got going on?
Hello?
Now we got you.
Okay, gotcha. So I had to I have to take my headset off, so I have a toddler. So forgive me if she does join us. She likes to join us on a few calls every once in a while. So my name is Fred McConnell, and I am, as Michelle mentioned, I am a vice president of lending and investments for Madison Development Corporation. So Madison Development Corporation at NBC, we focus on helping hard to finance businesses with providing access to capital through many different funds, as well as our current partners. So we have a number of lending partners that we work with as well, working on whether Main Street or even venture debt lending. So I get to cover the gamut on our side. We also own some affordable housing as well. So we're a fairly large affordable housing owner in the market. So over 300 units, and our goal mainly is to provide employees with options for affordable housing, keeping employees here in the Madison market, and we use those tools for that purpose. Prior to that, I have a lot of experience in commercial lending. I had over 14 years of experience working with a number of banks. Michelle had mentioned a few. So also including JP Morgan in the past. Worked on both the commercial banking side as well as the investment banking side. Um, um, Handled a number of roles, but my main role or my most proud role was providing access to capital for business owners in the market. So I'm really excited to talk about that subject today. Please feel free to ask any questions you might have. I'm gonna just have some natural times to just stop and unpack any areas that might have been a bit challenging. So please don't hesitate to ask any questions. So I'm gonna share the screen, and we'll get started with the presentation today. All right. All right. Can you see my screen now? Beautiful. All right. So we'll get to the beginning. So the name of our presentation is just obtaining a business loan. And after this discussion, I'm not going to promise that you'll be attaining a business loan right away. But I do promise today that if you have never had a discussion with a banker or anyone with experience on working on business lending before, that you're going to be more you're going to be prepared to have those discussions, at least to ask the right questions going forward. If you have had that experience, we might talk about some things that you that were not maybe a focus during that your initial experience. So I'm looking forward to any questions that you might have, but we'll get started with some of the basics. Alrighty, so the starting point of this discussion is first, we're going to set some, we're going to talk about some definitions today. It's important when you're talking about lending to also consider that banks don't really, what banks are looking for is that there is also going to be some type of investor, I'm sorry, some type of owner contribution that's made to any given project. So that typically comes through the form of equity. So we'll talk about what equity is, what debt is, as well as just kind of setting the ground or setting the table. So there are two main funding sources, of course. One source would be equity, and equity is just an investment in the business. So it's really an ownership stake. Um, when you have equity in a business, you really have you really have ownership in that business, or if it's in a corporation, it's shares in that business, and that's an opportunity to be able to secure funding from more of a partner or from from acquiring or ownership in that entity. So that's really the way that most business owners are getting started is through some type of investment of capital or of some type of collateral into the business, and collateral just whether that is something that's going to be used to get you going, get you started. But that's equity, and that allows for that having that ownership to get started. However, debt is a very important tool. It's an important tool to leverage, and so just the definition of debt is money that is borrowed. It's typically in the form of a loan, and with debt, the transaction really is between a lender and a borrower, and at the end of the day, the goal is to pay that lender back in the form of interest. So that's the simple way of putting it. So both may play a very important role in the process of funding a business. All right, so we'll talk a little bit about initial sources of funding at this point. So oftentimes the bank is considered the most popular form of funding. However, it's not the only form, and it's not often the start for opportunities to fund. So when we do think about funding sources, um, we look at it from the ability for funding to be patient to the bank, where the bank is not necessarily considered as patient in terms of capital. So personal savings, of course, ends up being a starter or a Kickstarter for many business owners. Any type of equity in assets. So in this example, there's equity in a home that could possibly be tapped into through maybe a line of credit or maybe a loan. So any type of assets that that an individual might have could be leveraged to ultimately be used to help start a business. And then friends and family, what I call love money, is really and also a source, ends up being a great source for startup. If you have friends that might be very interested in investing in your business endeavor, or that just love your product and are supportive, that's just a good way to get started. And it's often the first form of financing for most of our startup businesses. Uh, but there are also other forms as well. And I think we'll get to talking about those today. But many of those forms might include government assistance, government grants. There's also investors that that might be sources of financing as well. And then there are different programs. I think we talked about today in accelerators. I know G-Beta in the market as well. There's opportunities for funding in all those places. And it really just depends on where the business is in terms of the current where they are in terms of the ability to be attracted to which type of funding on what might be considered the best. And I do say that acknowledging that everyone has a different levels of privilege when it comes to funding sources, but there are definitely many sources that can be used to help get your business off the ground. All right, so we're gonna focus today, of course, on banks or financial institutions. So after this discussion, I'm gonna stop and then answer any questions that you might have about some of these resources. So when we talk about bank loans, there actually are a number of different products that can be used or utilized depending on the nature of the project that needs to be financed, or whether you're acquiring an asset, a tangible asset, or equipment, or the need is actually working capital. So we'll go over a few of those options today, and then we'll talk a bit about it as well. So one of the more popular, at least more popular options, because I think borrowers believe that it's the most flexible option, happens to be a line of credit. So there are definitely great benefits of having a line of credit. The line of credit happens to revolve. So what that means is that you're able to utilize the line of credit, pay it off, and then utilize that line again. So it is a revolving solution, depending on the level of complexity. It could be quite valuable because it can be collateralized using assets from the business. So if you have, depending on your business, whether you have inventory needs or whether you have, if you have receivables that need to be turned to cash, that line of credit can be used as a short-term gap to finance to provide cash to allow those assets to turn to cash. And that's really what a revolving line of credit is for. Sometimes they do get abused. Often they get abused by businesses that might use them for mismatched purposes. And we can kind of touch base on that as we go. But mainly a revolving line of credit is really used to support working capital, which is short-term capital and not long-term capital. And often businesses find challenges when they use that short-term capital, which is line of credit, for long-term purposes. So that could be equipment or anything that might take that has a longer life and is better served with a more permanent solution. And when I talk about more permanent loan solution, I'm talking about a term loan. Term loans, the benefits of term loans are that they have a number of fixed components. So interest rates are typically fixed, although they can be variable in certain circumstances, but they tend to be fixed. There are many options for term loans as well. Term loans, they are what you're hearing there. They have a specific term. However, they can what is considered amortized at different rates, depending on depending on the asset, the life of the asset, and the ability to or the need to structure the loan so that the borrower has a better ability to repay. For example, let's say that you do get a term loan for acquiring real estate. term loans are typically, they have terms that might be as short as, they can be fairly short, but let's say for real estate, 5 years to around 20 years. It's more typical for them to be shorter than longer. There are also rate advantages to keep the term short, and it does depend on the bank's cost of capital. It's about risk at the end of the day, but they can then amortize, or actually that loan would fully pay out in a at a longer duration. So maybe that loan might have a 5 year term, but amortize over 25 years. So that loan would look like the payment would actually be for a 25-year loan or 25-year payoff, but it would only be for a 5 year term, which means that these commercial bank loans or business loans in this for real estate are often, they need to renew over short periods, whereas your residential real estate, it's usually there's different options. You could fully amortize those loans, and they're much longer. There are also options to fully amortize loans as well. But again, the importance is that term loans are matched to the purpose, or typically to either an asset or to real estate. Something that's more tangible is usually the main benefit of the term loan. There are options for working capital, but term loans end up being a really good fit though for that. So I guess moving to secured versus unsecured lending. So when we talk about secured lending is usually lending that uses some form of collateral, usually collateral that is fairly highly liquid. So for example, as a banker, I had a number of clients that might have had challenges with attaining business credit. So I was able to help them by maybe setting up a CD or a certificate of deposit or a savings account, and fixing a certain amount of that savings or CD to allow the borrower to lend up to the amount that they had saved with our bank. This is a great way to help build business credit, or help give access to business owners that wanted to keep their balances with the bank, but needed to have some type of liquidity so that they could utilize it at the appropriate time. So that is an option. Unsecured lending as well. In terms of unsecured lending, that is ultimately business owners prefer having unsecured lending options. Of course, they want to free up their capital, their cash, their assets to be able to leverage them in other ways. So that is a preferred source of lending, but in terms of building your business, it's secured lending ends up being a great option or a great solution that should never be forgotten there. Um, we'll move on to personal guarantees as well. Most loans require, for small businesses, personal guarantees. A personal guarantee is an agreement. It's actually a signed agreement with a loan that states that the owner or the principal, so the individual that represents the borrower, will guarantee or support the loan in the event that the business is unable to pay the loan. This is a very standard practice with small businesses. There are scenarios where businesses are able to secure financing without personal guarantees, but at least at the startup point, a personal guarantee you're not going to avoid it. So that means that there are credit considerations on the personal side that are often that must be met. There are also minimum credit score requirements that small business lenders are looking at, commercial lenders are looking at as well, especially when a personal guarantee is made towards the loan. But at the end of the day, it ends up being, like as I mentioned, an important area of business financing that must be considered when looking at loan options. And then from there, I'm going to actually stop because I went over a number of things, and I'll see if there's any questions.
So it looks like there were some in the chat, Fred. So let me see.
Okay.
It started back earlier about kind of friends and family, but it seemed like that sort of got covered. There was a recent one, just a little bit more clarity between secured versus unsecured lending. And then I guess back to friends and family, if you could speak briefly on maybe, it sounds great because you just have to hit up your friends and family for money, but what would be some potential downsides of taking friends and family for small businesses such as
Right.
this?
Absolutely. So the downsides of that is when you owe friends and family money, it could hurt relationships, unfortunately. Friend and family, friends and family, they want to see businesses do well, but maybe friends and family may not have the the ability to be as patient as an individual might be when getting a business started. And because of that, we there needs to be some care to how that could harm relationships if a business does not do well, especially if that friend or family is providing equity. There's risk involved there. So um, the the investor at that point, the family member, has to be ready for potentially not being secured and being paid back. So that's one of the main risks that I see. Um, so with that, that's definitely that could definitely be a challenge. Often also, so depending on the privilege that your friends and family might have, um, that might not be as lucrative as a option. So that's why it's important to leverage as many options as possible, including um, your personal ability to bring capital in as well, whether that is from employment, whether that is from side hustles, whether that is from your ability to leverage your personal credit in appropriate ways. Um, all of that must be on the table. And I think that there was also a question about more secured versus unsecured debt as well. So with secured debt, um, there are a number of, like I said, benefits of utilizing secured debt. Of course, it does help to kind of break through that barrier of of having business credit. There are a number of lenders that provide some sort of secured debt, including secured business credit cards, which are becoming more popular in certain areas as well, where at the end of the day, the business owner is providing their cash, their collateral, and the bank is providing a commitment, a credit commitment, allowing the borrower, allowing the business owner to utilize that credit and build their own business credit because of that. So it ends up being a important tool that one should leverage. It is not going to, at the end of the day, as a business banker, as a lender, I always recommend, it's important to look at ways to help improve personal credit. So business utilizing secured loans as a means to secure business credit alone is it's a great strategy there, but it does need to also involve improving your personal credit so that you become more so that a business owner can have opportunity for other forms of credit that may be less restricted on the unsecured side. Did I answer all the questions or did I miss any?
There is one additional one.
All right.
Melissa, do you want to go ahead and ask Fred what your question
Yes.
is?
Yeah, so kind of involved with this whole conversation, I'm aware of, the importance of establishing, simply getting loans in order to establish credit, right, from a personal standpoint. But I guess I really haven't thought about it from a business standpoint. My business happens to be, low capital investment upfront, which is great. But I took out some funds from my savings account and I'm living on them, right? So in order to kind of basically finance my business, and you mentioned this idea of getting a loan, having some savings that you use to pay that loan on a regular basis, for your commercial activities, so that you can establish some sort of pattern of commercial, good credit. Is that what I'm understanding you're describing?
So in terms of business credit, it's important to cultivate that. But I would absolutely I would also suggest as a business owner that that cultivating that business credit should not in any way affect your personal credit is just as essential in this process.
Yeah, no,
So,
I
yeah.
understand that, but I guess that's what I'm just kind of trying to wrap my head around. Like, as a commercial person, do I also have to establish, should I be getting a commercial business credit card? Should I be getting a commercial loan just to kind of establish that pattern of, yeah, I'm able to pay it in addition to, maintaining my personal credit in a good manner?
Right. So with
Is that important or no?
Right. So what I would suggest is that it depends on the need of your business.
Okay.
So I don't think that you should go out and secure business credit just for that purpose.
Yeah.
You should definitely continue to work through and make sure that your personal credit stays adequate, because at the end of the day, that's your gateway to securing forms of business credit, is having having personal credit that can that will help get you approved. And we'll talk a little bit about that as well, because your personal cash flow is essential to the process as a small business owner. But I would definitely not suggest just securing business credit for the purpose of flexing your business credit. It would really need to be, it's the right tool for what you need. So having a business credit card helps with securing or with paying for your operations. It's a great tool to use. Might get you some type of additional benefit. It helps with short-term capital needs, but ultimately you're utilizing that appropriately and paying that appropriately, and just going from there. So it just needs to match the need.
Okay, that's great. That's a good clarification. Thank you.
No problem. All right. So any other questions in the queue? All right. So we'll move on then if there are no other questions. We talked about personal guarantees being it's an essential part of business credit. If you have a loan where you own depending on the loan program, over 20% is for the SBA. If you're as an individual and you're over 20% owner on a business, you're going to be giving a personal guarantee in that instance. And in most small business lending programs, depending on whether it's 20% or 25% ownership, you will be giving a personal guarantee. So that's something to consider. But depending on all those components of credit, ultimately the goal of the financial institution, which is risk averse by nature, because the goal is to continue to cycle through, lend money, collect balances, earn some income off of that, but ultimately is to get money to continue to circulate. To do that, business banks will look to make what are considered good loans to businesses that are operating efficiently and can repay that loan. So the goal is to be repaid. And the sources of repayment, they come from a few resources, and they really never fail in terms of making sure that loans can be repaid. So that would be just positive cash flow. So a business that's generating more than its expenses, that has the ability to pay its debt service. That's going to be important. Additional liquidity from whatever forms that liquidity comes from, whether it's personal assets, business assets. That's a source of repayment for that loan. Personal cash flow. We talked about that. Small business, it's important that most small business loans are considering personal cash flow. As your business continues to grow, then those considerations become less essential in terms of the overall assessment, but it always isn't. It's always an important component. So having ability to pay back the loan in multiple sources is looked at as a benefit, as well as the option for collateral liquidation. And that's where it becomes challenging for bankers to make that money back. Unfortunately, collateral liquidation is the need to sell the asset or whatever was utilized, whatever the loan was used to leverage. Unfortunately, that becomes a part of the world of being a banker, but that is another form of repayment. So all those considerations are made when looking at the ability to repay, and a banker has to get really astute to being able to identify if the loan does have a challenge. These are the many sources that could be used to be repaid, for this loan to be repaid. So that's something that, as a borrower, it's important that you're thinking about when you're approaching a banker. It's not just that your business has the proof of concepts there. It could have great operations, but the banker is looking at my business and thinking, what happens if the business isn't there right now? How does the loan get repaid? So those are some considerations that you should think about as you're approaching a bank. So that kind of ties into the role of business lending in general to the market, to you as a client, to you as a business owner. The goal of a business lender is to be an advisor for a business, to make the right recommendation, to match the need to the resource. So the discussion that we had with Melissa was, should you just leverage business credit to improve your business credit score? And really, at the end of the day, the business lender's job is to review with you the needs of your business and make recommendations that make sense for your business where it is today, and think about where your business is looking to go and looking to grow, and help you position for that success. So being an advisor is important. The business lender also needs to be a resource person. They need to be able to make referrals and have connections that can help as you continue to grow your business. That's a key component that business bankers can bring to the table. Business lenders bring to the table. They provide financial tools other than lending. As a banker, I spent most of my time having discussions about cash management more than even lending, because I found that the business owners that I worked with had more challenges with managing their cash and being able to turn their assets or their current assets into liquidity than they did even with securing lending. So going to the basics ends up being an important component of being a lender, and your lender should be able to speak to how do you position yourself for growth, utilizing services even before getting to lending. So that's a very important component. And then the lender should have have connections with other business financial services as well. So having resources that might be able to help provide personal financial services is essential. With being a business lender, you're working with an individual. You're working with typically the business owner or key manager with the business, and it's important to be able to offer resources outside of even typical lending purposes. So having many business financial tools in the toolbox ends up being an essential part of being a lender. So talking about some of those other financial services or tools, we talked about business credit cards before. Business credit cards are become a very important solution for working capital for businesses. Business credit cards have levels of protection that are essential as businesses have needs to make purchases for their business to help grow their business. It can be an essential component for the business depending on the need and the tool there. So it ends up being a solution that is important for business lenders to be able to help their clients with. We have discussions about overdraft protection here. There's many resources that can be used for overdraft protection, including credit, but also savings accounts as well. I think really the goal is just to say, hey, there are solutions to help make sure that your accounts can continue, that you can make your payroll, regardless of whether your accounts have that have cash that you have cash in those operating accounts. But I think it's just important to know that there are additional resources to help. Merchant services, an essential component of many businesses, ends up being the ability to be able to take card helps to improve cash flow dramatically, makes it so that there's less of a need for borrowing or for lending at that point. So these are important components that your lender should know about, or at least be able to speak to. Payroll, ACH payroll, vendors, receivables. It's important that your business lender can speak to solutions that will help in all those areas. Being able to pay your vendors efficiently, being able to make payroll or take care of your payroll in an efficient manner that's electronic is an advantage that all small businesses they don't know the levels of support that they might have, or many small businesses don't know the level of support that they could have in those areas. And having a business lender to help provide resources to right size that solution is important. And then remote deposit captures on here as well. The ability to make deposits anywhere, utilizing a cell phone or equipment at your own business or in your own home, just makes it so that you have ability to um, to have liquidity, access to liquidity when needed, and no need to go to the bank if it's unnecessary. So just having those cash management solutions are essential. And as I mentioned, as a banker, that was often where I started with my clients, and it's where a good business lender starts with theirs. All right. So we will talk a little bit about, this is a very important component to the thought process of a business lender. And it's something that is taught to lenders that go through commercial credit training, that become specialists in lending to small businesses. And that's the concept of the 5 C's of credit. And just myself as a banker, this was a very important or essential component of my decisions that I made in lending. And still to this day, even as a nonprofit lender, I often go back to this resource. I think about it maybe a little differently in terms of how do I mitigate risk, but ultimately the tools stay the same. So starting off with the 5 C's, we'll talk about the first C that you see here, which is character. So character is corresponding with credit history. So really, at the end of the day, character, what that component is essential because it really helps me as a lender or any business lender get to know the business owner from their ability to repay their debts, to their ability to execute on money that is owed. That is an essential component of making sure that a business is willing to pay back. The character component is important because at the end of the day, like I said, business lenders are risk averse. The goal is to make sure that loans are made so that that the process of putting capital into the community and returning it continues, so that the lending process continues. And because of that, that component is number one on the list. When I talk about that, I do that knowing that there can be challenges in many borrowers might have areas of challenge with credit history, but at the end of the day, it's important to address challenges that borrowers are able to address on the personal end as well as the business side, and work on any areas that might be deficiencies, because it becomes an important part of that decision-making process, and it's number one for a reason. The next one is capacity. So capacity talks about the ability to actually repay that loan. So that ability is measured through ratios, and 2 of the ratios are actually listed there. Debt service coverage, which is DSC. Debt service coverage is simply the ability after your net cash flow from operations. So once you have paid all your expenses, the ability to repay your debt service, which is your interest plus your principal and any lease payments. So with that, having more money after expenses than your debt is really what it leads to. and the ability to, that's measured by ratios. So an active ratio of debt service would be, at this point, minimum would be about 1.1, 1.15 typically. 1.15 to 1.35 is the ratio. So for most small business banks, which means that at the end of the day, for every dollar of debt, dollar of 15 in free cash flows available to pay off that debt, relatively, from the business standpoint. For most for most individuals that come into that will set up their first small business loan or would look to borrow for their first small business loan, many of your banks are going to look at a global view of your debt service. So what that means is that they're going to incorporate not just your business's ability to pay back the debt. They're also going to look at your personal, and they're going to create a score that includes your personal cash flow or personal free cash flow to be able to service the debt, the total debt, as well. So that's why having that your personal side taken care of, or having your personal side working on steps to improve personal credit becomes essential, or personal cash flow becomes essential because of that. Moving to the next C, which would be collateral. So collateral looks at the assets that are pledged and makes decisions based on those assets. So it's important to realize that the loan might look different depending on the life of the asset. And when I mean life of the asset, that is the how long that asset might actually be able to be utilized or have value to it as well. That's an important component of the lending process. So computers might have, or certain technology might have a shorter life in comparison to real estate. So decisions are made depending on the asset and the life of that asset and the value of those assets. The lender will have to make an assessment of the ability to provide capital based on all those components. Also, when it comes to personal, often there are lending programs that require collateral on the personal side. So whether that is liquid accounts, whether that is that there are any other assets, even equity in the home, all that might be reviewed to be able to make the decision on whether that loan should get approved. So that becomes also another essential component. Capital is important. Business lending will not lend 100% to any project. So the ability to bring in other sources of capital in structuring a deal is essential. So the business lenders will look at that as a part of their assessment. And then conditions. When we look at conditions, we look at the general business environment, and we make a decision on the ability to repay that loan. So there are certain times in the economic cycle that are challenging for certain industries, or might be, as other industries might be counter to that and might have actually be more successful during those times as well. So business decisions are not just made in a vacuum. They're made with a overall overall view of the economy, and having those conditions are essential component of that process. When I mention these 5 C's here, it doesn't mean that every single You have to have every single area has to be exceptional to get an approval. And that's not the case at all. We're all, being that lending is a people business, we're all imperfect in many ways. We strive for might strive for perfection, but there are different challenges or different areas that there might be strengths and opportunities. And lenders think of that, they look at that as well. And that's an important part of that personal relationship that you have with your borrower. So with that, even if there are areas that might be of challenge to you as a business owner, the opportunity or the goal is for a business lender is to look for ways to mitigate some of those risks. If there is a shortfall in collateral, let's say there's not very much personal collateral available for a loan, are there ways to help make it so that that loan can be more attractive? The lenders are constantly thinking about, how do we make it so that the deal can work? There are areas of the 5 Cs that are a little bit more challenging than others to mitigate, but the lender is thinking through, okay, we can't make a bad deal a good deal, but how do we make a deal that might be imperfect more perfect? And the 5 Cs helps with that process, and it's overall the rubric that lenders might use. I'm going to stop here because there's a lot to unpack on the 5 Cs, and maybe answer any questions that you might have.
So Fred, Jasmina is sort of asking like a typical walkthrough of a small business borrowing across the 5 Cs. So she said, for example, if the business is an inventory-based business like custom handbags, somebody walks into your office, what are the things you're going to look for, and how do you sort of start thinking about the process? Is that correct, Jasmina? Is that a good characterization of your question?
Yeah, Jasmia.
Sorry, I apologize.
No problem. Yes. Like, can you give I know that I use quote for typical because there's no typical person or business, but if we are thinking about specific targets, so 25% personal assets, capital used for the custom handbag business, the person has this type of credit history and mix, that they have a home loan, they have student loans, their score is 719, imaginary. But if we can think about typical characteristics across the 5 Cs, would you be able to outline that example?
Okay, so I'll do my best. So just a typical example of an individual coming into a bank that is looking for a loan, and how that might relate here. So immediately, the banker is going to do an assessment of the current business and their ability to repay their vendors. They're going to really look at credit history as a part of that decision making process. So you can see that in the financials. So you're going to be asked immediately, hey, I need your tax returns. We're going to do a review. So keep that in mind. If you don't have tax returns, some type of projection to be able to help, but that's not going to, if you don't have a history and that's understood, we're going to look at your personal credit, and we're going to say, okay, ideally, if you're looking for a minimum credit score for an ideal borrower, that's a little challenging. I would say right now, just because we're all speaking candidly here, that the anything below a 550 would be very challenging to at all get any type of credit, and even secured credit. It's just pretty much impossible, just the way that the system is created. but an ideal borrower has a score that's north of that, north of the 650 range. 680 would be where many small business lenders would look at that borrower as having good credit. So having that good credit score and not having that, but not having that at least that gives you an opportunity from a character standpoint to meet that objective. But I'm not stating that below that you can't get a loan. It just becomes a little bit more challenging, and there might be some areas where you'll have to be stronger in the other components. From a capacity standpoint, you need to have that quick ratio for every $1.15 in available cash flow, net your expenses with add backs depending on the bank of depreciation, amortization, for $1.15 for every dollar of debt existing at this point, being able to pay that. So you need to have that cash flow to be able to service that debt, and you need to think about it as the bank requires that ratio. So being able to easily service your existing debt without adding additional debt is an important component. So that business owner will come in and already have the ability to service their existing debt, but maybe need to add additional component or bring in new inventory so that they can generate more sales to grow their business. So that's kind of where they are. In terms of collateral, they more than likely have some level of personal collateral, but if not, they have strength and character and capacity, so that we might look at other solutions to help with the collateral side. So there might be other solutions like the SBA. There might be a community lender like Madison Development Corporation that can help too. There's many different sources, but that ideal borrower has some form of collateral on the personal side as well that can be looked at or leveraged. From a capital perspective, that ideal borrower is able to, depending on the industry, can contribute between 10 to 25% of towards that acquisition or towards that project. So that becomes an essential component. And the way to get there, the banker might have some resources that can help with how to get there if we're a little short. But ultimately, the ideal borrower has saved some of that money and realizes that the bank's not going to lend to the entire project. And then overall, the product that the ideal borrower that comes into the bank has, that those handbags are well placed in the market and are unique to everything else. So there's a need in the market that was identified through that product that makes it unique to others, and the banker's able to assess that through reviewing the performance, reviewing the business, just knowing the market and being just a local player and understanding that product is unique and seeing growth maybe in that opportunity. So ultimately, at the end of the day, the banker's looking at all of that and they're making a decision on, hey, if they have those essential components, it's likely that we can move forward. If there are any areas that might be missing, we have to think about how do we make that imperfection? Do we have mitigating factors, or do we have to go back to square one in certain areas? I hope that at least helped a little bit.
Yeah, thank you. Examples are helpful.
All right. Any other questions on 5Cs?
There was a question, Fred, sort of about like if the credit score is a little bit lower, you may get a loan over somebody with a higher credit score because of these factors contribute. So just kind of reinforcing the point, don't count yourself out take your plan and your idea and all the things you're talking about, like understanding what the market is, what the need in the market is. Don't assume because maybe your score is a little bit lower that you might not be an appropriate candidate.
Absolutely.
Something I usually tell people too is just sometimes you're not a candidate for that particular lender because of their own portfolio. So, like for example, if you're a food cart and that lender has made a couple of bad deals to some food carts, it has nothing to do with you and your plan. It's just that they had some bad deals in that industry. So they're going to be perhaps a little wary of bringing on another one. So, it may take a couple different lenders, and that's okay. That's kind of part of the process. So.
Right. And Michelle made a great point. That's a valid point there. Remember that this is a people business. That the history of that lending is a people business, and the history of that lending institution predates even your business, your idea, and some of those components of that portfolio. It plays a role in some of the decisions that get made. But the good thing is that there are different options. There are so many different options that you can choose from in terms of making relationships with lenders. The challenge is, though, that there are so many different options that you will have as well. It takes time. It does take effort. It takes building relationships with bankers, with the right bankers, and often what helps is having currently an existing network of maybe business owners that you know, individuals in the community that are a part of the community that can point you in the right direction, at least give you some guidance on where you might want to consider. But yes, that's definitely a very important point. And one thing is also that it's so hard to not take things personal. Honestly, it is. There are components of this that are so challenging internally, especially on the credit score, the credit history portion of it. But I think the best way, I think, to deal with those areas of challenge, those challenging areas that create those anxieties, are to control the things that can be controlled, to reveal the challenges beforehand, because you're not gonna hide it. It's gonna come out. It's gonna show up in your history. It's gonna show up in your financials. It's gonna show up in your in the reviews at some point. Reveal it at the beginning, and the banker really, at the end of the day, they're incentivized to partner with you to find the solution, find solutions that can work. Sometimes it might take more time as well, and that's okay. And sometimes there might be other solutions that don't have the same level of risk, that of the same risk assessment, that might be a better fit at the beginning of your process, of your journey, and that will help you get to the end result. So I think that that's an important component too. Something to think about as well is that there are challenges in the industry, but hey, on to the next, because there are opportunities with others that are better fit. And that's I think essential component, because it can get challenging. It can be tiring sometimes when you're not perfect in certain areas here. But I think ultimately, I hope that knowing, hey, these are 5 criteria that they're looking at. You can do that self-check at the beginning as well, and build that resiliency even before the process begins, knowing what they're going to be looking at, being able to reveal it and being open to it where you are today, and working on the areas that you can control. But it's a challenging journey, definitely. But a lot of good. But Michelle, great points there. Any other questions on 5Cs at all? All right. So we'll move on. I
It's
think we
just as a reminder, Fred, it's 7:43, so just want to keep you on
okay.
track.
All right. So I think we went over most of this area here. The goal of the lender is to minimize risk, and they want the owner to be financially vested. So that's where some of these components with providing capital become an essential component of it. All right, so we'll talk a little bit about the needs. We kind of touched on this, identifying what the need for borrowing and which product makes sense, whether it's a working capital need or a asset purchase requirement. Those are essential components. Depending on working capital is more of a short-term solution. So we talked about a revolving line of credit, maybe a certain loan that's structured in a way that will be paid off in a shorter time period. Just knowing what the need that fits that request that you have is essential. And going into the bank and making this decision and knowing that those decisions will be made accordingly. I'm going to go into small business, the SBA, real quick. I'm not going to go into all the details here because some of this is actually more on a more advanced side. But the SBA ends up being one of those mitigants that I discussed with you. You know, at the end of the day, the Small Business Administration provides 2 loan programs. They are not replacements for the banks having a process, and the loans that get approved typically with the SBA are bankable loans that needed to have some type of mitigant to help get it to approval. So whether there might have been shortfalls in collateral, maybe there wasn't enough collateral in certain areas, or maybe there was a capacity challenge, the SBA is just a solution that helps to get banks to get to approval. So there are 2 products, the SBA 7A product and the SBA 504 loan program. They are different solutions. There are common uses though. SBA 7A loans are a general purpose loan. They can be used for many different purposes, including working capital. They can be used for real estate. They can be used for equipment. There are different solutions that it can be used for. The SBA 504 loan program is fixed asset focused. Real estate projects end up being a great target for the SBA 504 programs. There are a few other components that are a bit different for each, depending on your need overall. But the goal is just to state that the SBA is another solution that banks might use to help get to an approval. So we'll move on to the next slide, and I'm sure I'll answer more questions about the SBA if there are any after this discussion, this slide as well. The final slide that I have here is just the type of financial institutions that you might be able to partner with. As was mentioned, there are more solutions than just the national charter banks. There are more solutions than just specific banks that you can utilize. Credit unions end up being a great choice for many business owners. The bankers and credit unions have such great experience working with small businesses as well as individuals. Many credit unions are having to build a certain niche depending on the small businesses that they interact with regularly. So this ends up being a great tool. Many of them are cooperative in terms of ownership structure. They have a not-for-profit mentality and more mission-based. It just very similar in a respect to nonprofits in the market. So this ends up being a great solution. Banks are also they can be a well-placed solution as well. They're stockholder owned, so ultimately they answer to board of directors. They're publicly traded, so there are different considerations there. They are for profit, so that there's just the need to understand there are different considerations that banks have when they make decisions about how they service communities. But there are great bankers at banks that will work to help borrowers to achieve their goals, just like there are at credit unions. It's just that the motivations for the institutions might be a bit different. Community development financial institutions are also an important component. I think Michelle will dive into some of these, but my organization happens to fit in this bucket, we'll say. WIBIC happens to fit in this bucket as well. In other nonprofit, mission-driven financial institutions that are private but have that mission-based approach fit in the community development financial institutions arena. Loan decisions are made very similar to how banks make the decisions. However, there's greater latitude that is given to borrowers because, as I mentioned, this is mission-based work. The goal is ultimately to provide capital for businesses that might have challenges with access. So that is the focus mainly of those community development financial institutions, even though the underwriting looks very similar often to the credit unions as well as the banks. And from here, I'll just talk about what we might have learned today. We won't go into too much of the underwriter itself, but ultimately, at the end of the day, the process for completing a loan, it starts off with your partnership with the business lender, but there's a team of individuals that you will work that business lender works with. There are individuals in the background that helps with the underwriting process, that helps to determine whether a package that would be completed by a front of the office lending team gets approved. So there are many different eyes that kind of review the loans that come to the lender, even though the lender is the face of the deal. But it's just important to note that at the end of the day, your lender is going to do everything they can to make sure that the process is as seamless as it can be. But because it's a people-oriented business, the challenges happen along the way in the process. So it's important to make sure that you hold the lender accountable. But at the end of the day, just realize that it is not, there are certain decisions that are not in the hands of that lender. The lender is really just the face of it in certain areas, but they're an important face because they're your advocate through the entire process. So their job is to get you from start to finish, but utilizing resources on the back end to help to get you to that approval. So I went a little bit long, but I'll just open it up for any additional questions that we might have today.
So everybody, next week, I'm up for the next 2 weeks. And so I'll just follow up next week with some other resources too. So around crowdsource lending and some other things. So don't worry, we'll cover it all between the next 2 sessions that we have. So if there's any questions for Fred or how this lending process works, now's a really great time to ask. I think there's a lot of always a lot of angst, like, should I go for a loan? Shouldn't I go for a loan? When should I go? I think Fred made some really great points today about it's hard not to take it personally if you get turned down, when sometimes it has nothing to do with you, it's them. So feel free to jump in with anything that you're thinking about or you're worried about.
But yeah, while we're speaking to that, it is for me. I'm also I also wear some of you I hear are I know that Jasmia. Hope I did not get Jasmia's name incorrect. I do apologize if I did. Happens to be on a real estate investor as well. So I wear that hat as well in terms of challenges of access to capital, especially being that I'm newer to the industry. I've been in it for about 3 years now. So I definitely understand. I've sat where some of you might have sat as well, attempting to secure my first loan, and it helped that I had some experience in this seat that I'm at right now. But it does not take away from the anxiety that there could be that components of the process might have. However, I would state that ultimately knowing why you're doing what you're doing is essential. Is to get your business to that next level, and funding is fuel. So with that, it's a component of a grind that all of you are committed to getting done, and which is to do everything you can to get your idea, your business, your next great thing off the ground. So it doesn't make it easy, but it absolutely is an important component.
I do have one additional question, which we might not be able to answer. It relates to, so in the last year, financial institutions have been making a commitment to ensure that there's greater equity in lending. So recognizing that historically women, people of color did not have access to, because of systemic factors, typical forms of lending. I think, and UpStart is a targeted program. It's open to everyone. So the question that I have is, how do we, for folks where those funds are available? So for example, Generator had an offering for Black and Brown startups. Really use those opportunities and the consciousness about equitable lending to our advantage.
Outstanding. So I think knowledge to all of these great resources is an essential component of that. Part of the challenge that not only the challenge of being part of a community that has systemically been disadvantaged by practices, by funding sources. There are also access to information gaps that exist that makes it so that just compounds those real life systemic challenges as well. So I implore everyone here that the lived experience is that there are components of the process that folks have been shut out of, to build their knowledge of all key areas of the lending process, of funding process. Banks are one, but there are other areas, including accelerators that you mentioned, government lending sources. And then I implore the community, like my community, in terms of my work community, to find the CDFIs or community development corporations to do even more, to partner with other organizations to be able to provide that access to be able to be that connector to those resources that do exist in the market. part of the challenge is that there are resources that appear they might be sparse, but there might be connections that can be made to get to those resources, and we have to be better connectors to be able to do that. So it ends up being all of us need to work to being that better connector, but educating yourself on what might be available, partnering with organizations. Banks could be one, but other organizations as well that have inroads to other resources, and just building that exercise of reaching out to multiple sources, multiple resources, gaining that education to give everyone the best opportunity for success on the funding side. Some folks have this access and this privilege just in a more natural setting because of how society has set up systems. It takes even more to get us all up to the level of resource. So it's really education. It's really learning. It's really learning what exists in the market, being that at least that leveler at the end of the day.
And organizations like Small Business Development Center are here for everybody to be able to provide that, that business plan review before you go, just sort of the kind of walk through what you're going to ask for, and just using and leveraging this UpStart community. Once you're done with this program, you're still part of this program always. So, if there's ever a time when you're getting ready to go, seek some funding or what have you, you're welcome to reach back out to Katie or I and ask for help or a connection or an introduction or whatever it takes too. So, Fred's point is so well taken about just, trying to help get that word out and level that, trying to level things up a little bit.